Okay, so I was just saying a second ago, we've got a lot more people registered than are in here. So as I suspect, people are going to be watching the recordings. It's now a couple of minutes past noon, so I think that we probably should get things underway. What I'm going to talk through, and I'm going to go through at quite a clip, quite a pace. I'm going to talk through just some of the fundamentals that I look for when I'm looking at charts. In some ways, I'm going to be kind of pulling together some topics that I've talked about in various webinars. So if you click on the webinars link on the website and scroll down, you'll see other prior Back to Basics webinars. You'll see webinars that relate to flushes, trend strength, changes of behavior, context, all these types of things. And so we're going to talk through all of those. So I probably should start by talking about slopes, because I think it's kind of where my analysis has really evolved from. Initially, everything that I did was based upon slopes or channels. So I'm trying to think of a good channel to go and look at. Let's go and look at, what's this? That's Japanese yen. But actually, that's not a bad slope. There you go. So I think everyone's pretty much familiar with this, a regular channel or a slope. But here's the thing. There are two tools that I use typically to find a channel. The first being an Andrews Pitchfork, which historically was the original form or tool that I used to find a slope. And to me, a pitchfork is nothing more than a tool. It's nothing more than a screwdriver, effectively. So it's a way to find a slope. And there are different variants of pitchfork. So what you're looking at right here is an Andrews Pitchfork. There are two other, depending on who you talk to, there are multiple variations on an Andrews Pitchfork. But really, for my purposes, there are only three types. There is the original Andrews Pitchfork, which is what you're looking at, where you have a median line. The median line is the spine of the pitchfork, and, technically, it's the median or middle of the BC leg. So the middle, it's a line drawn from the A pivot through the median or middle of the BC leg, and so that's why it's called the median line. Some people refer to the upper and lower parallels, which is the upper parallel in this area here and the lower parallel in this area here, as median lines as well. The upper median line, the lower median line. They're not median lines, they're just parallels. There are other parallels that you can draw. So once you've got your pitchfork and you're convinced that your pitchfork is working, which we'll talk about in a minute, you can derive other parallels off of that same slope. But essentially what you're doing is you're using a pitchfork simply for one reason, which is to find a working slope. So again, that's an Andrews Pitchfork. Now, there was a trader out of New York from memory, and his name was Jeremy Schiff, and he proposed that if you actually took the A pivot and you moved the A pivot vertically half of the way up to the same level as the B pivot up in this area here, so move the A pivot from here to around about there, that's another variation on a pitchfork, and in fact there it is. So that's a Schiff. So that's a regular Schiff, named after Jeremy Schiff, and it gives you a very, very shallow pitchfork. So very often, if you see markets which have been in free fall, which is fairly relevant right now, and then they start chopping into more of a sideways action. So think about the euro. The euro has been falling, and now it's been in a sideways action for the last week or two. Then very often, if you use something like a Schiff, it will actually allow you, so for example, in this instance, maybe you've got a vehicle that's been rising, and then it starts getting into more of a sideways drift, then this type of fork could be useful. And then Alan Andrews suggested, well, hang on, if you're going to be moving the A pivot 50% of the way up in price, then you should also be moving it 50% of the way forward in time. So essentially what you're doing is you're moving the A pivot from here to probably somewhere in this area here. And that's a modified Schiff. So if we turn this into a modified Schiff, you'll see that that's exactly what's happened. The A pivot has moved up 50% and then across 50%. And essentially it's a line drawn from your A point to your B point, and halfway along that line is where your A pivot gets moved to. Hopefully that kind of makes sense. And that's a slightly less flattened slope. So if we look at all of those slopes, get those circles out of the way. So what you've got is you've got your Andrews, and see how steep that is. You've got your Schiff, You can see it's very, very shallow. And then you've got your modified shift, which is actually, somewhere between the two. There is something that's fairly special about a modified shift, which is that if I go back to an Andrews pitchfork, and if I draw in a line from your A pivot through your B pivot, and I extend that line forward, there you go, like that, very often you'll see that referred to as a Hergopian line. It can be called a Hergopian line, but for me, it's basically a modified shift, because if you now take the modified shift, which we'll turn this into, you'll see that suddenly the floor of the fork becomes that same line. So essentially, a modified shift has a slightly peculiar feature, which is that if you actually come down into support on a modified shift, even though it looks like you're saying to yourself, well, actually, we've now got 2 points of support, technically you've got 3, because the A pivot, which is down in this area here, so let's assume you've come down in price, you've bounced, you've done something like this, you come up, you're doing this kind of movement here, and now you're coming back into support. Whereas with a shift or an Andrews fork, when you come down for your first touch at the lower parallel after your C point, you now have 2 points of confirmation. In a modified shift, you actually have 3. Hopefully you understand why. So if I actually just draw in a parallel line from the pitchfork, and then move that line back into this area here, hopefully you can see straight away, okay, with a modified shift, you actually have 1 point of confirmation, a second point, a third point of confirmation. So with a modified shift, you can prove the slope, if you like, earlier than with the other two variations or variants, purely because of that unique aspect, which is that the A to C line is actually the same gradient as the pitchfork itself. Now, you're probably going to hear lots and lots of things, depending on who you listen to, about statistics that say, I can't remember what the statistics is now, is it like 80% of the time, once you draw in a fork, 80% of the time, price will hit the median line. I personally think that's nonsense, because if you can draw in on any given chart, you can probably draw in like 50 pitchforks. You can take every single high, every single low, and there are almost, there are hundreds and hundreds of pitchforks that you can draw in. If you actually do that, you'll see it's nonsense to assume that in 80% of instances that you draw in a pitchfork, you will gravitate towards the median line. I use a pitchfork simply for one reason, and it's to find a working slope. Very often when I do mentoring, I actually suggest, because I find that people tend to, with pitchforks, they tend to use them as crutches. And all I mean by that is they'll draw in a pitchfork, and for example, we've had confirmation down at the lower parallel, we've had a second bounce at the lower parallel, and when we start rising, I find that people start getting really kind of jittery up in this area here, and I say, well, what's the problem? And they say, well, I think we're hitting the median line. I think we're about to turn lower. And I always say the same thing, which is, why are you paying attention to a line that has never worked? If previously we do this, and then we come down and we get long, and we come back up, and we see resistance, we come down, we find support, and let's just say you've taken a long here. Your stop is here. In this instance, I think you would be absolutely correct to be getting nervous once we get up into this area here, because the median line has proven itself to be active. You can see that we have resistance once, we have resistance twice. Yes, I would be taking some profit in this area here. It's not complicated. But if we go back to this situation here, and you've just got long in this area here, I would ask, why are you getting nervous in this area here? The line has never proven itself, and the same up at the upper parallel. If the line has never proven itself previously, as far as I'm concerned, it means nothing. So I don't particularly, I view that pitchforks are kind of a double-edged sword. They can be useful for finding slopes, but once you found the slope, very often I actually recommend use the pitchfork to find the slope, but once you found the slope, actually just replace it with lines and then just get rid of the pitchfork, because otherwise you're going to start fooling yourself that maybe you're going to see support or resistance at the median line or the upper parallel where previously they'd never worked. So the other tool that I use is not particularly complicated. It's simply a channel. And I prefer a channel. Now, I don't honestly know if I go and look at some of my charts now. In fact, most of them are horizontal, especially in the EU pairs. But if you go and look at most of my slopes, I think you'll find most of my slopes more recently are actually channel derived as opposed to as opposed to pitchforks. I prefer the channel because it's much more free flowing. And so if you think about it with an Andrews pitchfork or a sheaf or a modified sheaf, you have 3 slopes that you could potentially find by using a set of pivots. Whereas if you use a channel, it's much more, you have much more freedom in terms of drawing the slope. I mean, I still have some, rules that I look for in terms of drawing in the slope. I use significant highs, significant lows, but it allows me a lot more freedom. So I do like to use channels. Now, here's another thing that I find that a lot of people struggle with. A lot of people say, well, Paul, you seem to be focused on slopes and channels, and that's all very, very well. But, how come you're so focused on horizontal lines? And I've never quite understood this one, because if you look at mathematically, this has a gradient and it has a slope value. The slope value is whatever it is. This has a slope value. The slope value is 0, but it is a slope. You may say it's not a slope. It is a slope. Why is it not a slope? Of course it's a slope. Think about it this way. If you are willing to trade something like that as a channel, and if you are willing to trade something like that as a channel, why would you not be willing to trade something like that as a channel? It has a slope value of 0. So therefore, I view this no different from a downtrending or an uptrending channel. I would look for resistance, I would look for support. I would look for resistance, I would look for support. I know this is all super simple stuff, but the way that I look at charts, I think it is really simple. There is nothing complicated in it. I think people overcomplicate things. So when I look for a trend, so let's say that we have a trend. There you go. We've got a nice little trend going on in whatever vehicle that we're paying attention to. The way that I look at trend strength, is really quite simple. And the analogy that I have often used is that, and for those of you that I'm trying to look at the names now of attendees, and I see some people in here that have probably listened to 3 or 4 of these Back to Basics webinars. The analogy that I use is a runner on a treadmill. And I know that someone now is like raising their eyebrows and going, oh, here we go again, the bloody runner on a treadmill. Think about it this way. You're on a treadmill and you are trying to run forward on the treadmill. The treadmill is rotating towards you. It's pushing you backwards. I view a trend to be a treadmill. So in this instance, you, the runner, are expending energy as you start running. The trend is trying to push forward higher in this instance. The treadmill is pushing against you, but you have lots of energy. Because you have lots of energy, you manage to get to this point on the treadmill and you start running out of breath. And so as you run out of breath, you take a moment to get your breath back. And what does the treadmill do? It pushes you backwards. And so what happens is you start running again. And as you start running again, because you have equal strength, you run out of breath in kind of this area here. And you take a breath and you start to get pushed back again. You start running again. What does this say about trend strength? It tells me that the runner, if anything, it has more strength. The runner is able to get even further forward on the treadmill. And when the treadmill pushes him back, he comes back to this area here. So the trend has strengthened. And for me, the way I look at it is the floor has stepped to the upside. So without being pedantic, actually this is not a floor because it only has a single touch. But what we'll assume is there's been a second touch back in this area here, and then we did that, and then we did that. Brilliant. Now we have 2 bounces, so now it's a floor. A single touch does not make a floor. It could be just a coincidence. In the same way that a single line does not give us a line. A single line is a place to watch for support, subsequent support. But once you see subsequent support, brilliant, you now have a proven line of support. If you think about it that way, it prevents you from, so if you have a low in this area here, and then a low in this area here, and a low in this area here, the problem you have is you could be drawing in a line here, and here, and here. You end up with like lines all over the place, and it turns into a bloody mess. So to me, a line only exists when it has proven itself. It proves itself when you actually have a minimum of 2 touches at it. Hopefully that's all fairly clear. So in this instance, the runner has actually improved his performance. He's actually got higher in the slope. And if we see a move higher now, I would probably be looking for resistance up in this area here because the runner has improved his performance and I'm expecting him to get up to that area there. Now, to be fair, we could see a change of behavior and he fails at the original ceiling, but I'm probably going to be watching for him to get back up into this area here. And so that's why you'll hear me talking a lot about context. For me, context is basically stepping higher or stepping lower within a slope. Or to put it in another, to phrase it another way, it's the runner running out of energy or gaining energy. It's, we're doing better, we're doing worse with respect to trend strength. So let's assume now that we continue forward. And now what happens is we see something like this, and we see a punch back down to this area here, and now we come up into this area here, and we come back down and we find support, and up we go. Now I'm really nervous, and for very obvious reasons. I'm very nervous because the runner is now running out of energy down in this area here. The runner is actually weakening. The trend is weakening. And what that alerts me to is potentially this, a break to the downside, because the runner is running out of energy less far forward on the treadmill. The treadmill is doing a better job at pushing him backwards. What I'm probably going to expect is this. But what I find is that people then expect this. Maybe not. But think about it. If back in this area here, all we did was create a higher ceiling, why would you, just because we've taken out the floor to the downside, expect that we're about to do this? Why would you not equally expect that what we could do is this? Put in a lower floor that looks something like that. There you go. There you go. That's it. Something like that. So yes, it makes me cautious to the downside, and the way I sometimes term it when I'm looking at charts is the tide is turning. Hopefully, again, that's fairly self-evident. It was looking good, looking good, looking good. Now it's starting to look slightly more worrying, and so I'm nervous of something like this, but I still need to see evidence that that's going to happen, because what could happen is that the runner, I don't know, has like a Gatorade or something, gets more energy, comes back down and regains his footing, and does something like this, in which case we're bullish once more and we're back off to the races to the upside. Now, having said all of that, once we do this and we drop below the slope, it is bearish. I mean, it is bearish. But what I find is, as soon as you use the word bearish or bullish, people just have this expectation that, okay, bearish, brilliant, we're about to do this. No, I'm saying it's a bearish event, but let's see what happens next. What I now ideally need to see happen is this. I need to see resistance up in this area here. And if that happens, what am I going to start doing? I'm going to start drawing in a downtrending slope, and I'm going to start looking for something like that. It's very, very, I think, simple. And it's essentially identifying a slope, proving the lines within the slope, identifying the trend strength using that runner and treadmill analogy that I just talked about, identifying changes of behavior essentially being a rising or a lowering of the floor or the ceiling, instances where potentially support becomes resistance or vice versa. So another bearish instance would be, yes, it would be resistance in this area here, but it would also potentially be something like resistance up in this area here. And by the way, it could also be resistance in this area here, all the way up in this area here. One of the reasons that I like sometimes moves like this, where you see a punch up into this area here, and very often you can see a really sharp reversal to the downside, is because if you think about what is it that 90% of people are paying attention to, if they're not looking at slopes, let's be honest, they're all looking at this. They're looking at exactly that, an orange, well, not orange, they're looking at a horizontal line. They're saying to themselves, this vehicle has topped here, it's topped here, it's topped here twice. Oh, look, we're above, we're at recent highs. This is wonderful. Off we go. We're off to the races. And so you'll find a lot of people getting long in this area here. Whereas for me, popping up into this area here, we're simply popping up into resistance. And this is almost like segueing into why I like flushes so much, because flushes are essentially, that is essentially a flush. What you're seeing is a pop to the upside, up into this area here, above the prior high. People think, brilliant, it's a fresh high, off we go to the upside, and the next thing, we crater back to the downside. I would suggest that And, if you'd asked me this 3 years ago, I don't think I would have agreed with this, but I actually think that a far larger percentage of my own trades in the last year have come from flushes and breaches as opposed to slopes. I think slopes are incredible. They will tell you your trend strength, changes of behavior within the trend. But the momentum that you get from a flush is absolutely incredible. When you think about the psychology of what a flush is, and it's people being basically wrong-footed on both sides of the trade. Because if anyone in this area here is saying, I want to be short this vehicle, what happens is when we pop to the upside up into this area here, they get stopped out of their short. Anyone that wants to be long the vehicle, well, they're probably seeing this pop to the upside and they're getting long. So what you're finding is shorts are being stopped out, longs are being created all up in this area here. Or to put it another way, lots and lots of people are being put on the wrong side of the trade, either taken out of their shorts or put into their longs. And then, of course, when the vehicle starts rolling back to the downside, the shorts that just got stopped out are thinking, crap, I need to get back into my short. I knew I was right. I need to get back into it. The longs are thinking, what have I done? I've bought another breakout. Why the hell have I done it? I'm never doing this again until tomorrow. And then they'll do it all over again. And so that's why I think that these flushes create such massive momentum in the opposite direction. And if you want to listen to me warble on more about that, click on webinars and you'll see I have a webinar which is called Flushes and Breaches, and I talk about that in a lot more detail. I don't know if we've seen any flushes recently. I know the euro's been like spectacularly quiet. I'm trying to think where we last saw a really nice little flush. I think that was a flush, was it? We're down to 15, we're down to 18. Yeah, actually that was a flush. So actually that was a flush, but just barely. There you go. Look at that little flush there. So this is Canadian dollar. So on the 5th of this month, we popped down to just beneath the low from the end of the prior month in April, to the tune of, it looks like 6 pips, a 6 pip flush. And look at the reversal back to the upside. I think that the most spectacular example of a flush that we've seen, and in fact this week, was actually Nat Gas. When Nat Gas popped down to the 643, we flushed it by 8 ticks for less than 1 minute, and then we went from 643 to 755, which is a huge spike to the upside. And again, that's to me, that's a short squeeze. There is a short squeeze underway there. People have been put on the wrong side of the trade, and Nat Gas is being chased back to the upside. Okay, we've talked about slopes. We talked about the fact that a horizontal is a slope. The fact that we've talked about pitchfork variance. We've talked about using a pitchfork versus a channel. A proven line within a slope. I don't know whether this is particularly complicated, but when I draw in a slope, all I'm looking for is, again, think back to I always go back to the runner analogy. But if you go back to the runner analogy, all I'm really looking for is, okay, on this day here, on the 24th of April, the runner ran out of breath here, took the trend pushed him backwards, and he started running back in this area here. Has that happened anywhere else? In other words, have we got anywhere else in this slope where that level has worked for support? I don't see it. Is there anywhere else where that level has worked for resistance? I really don't see it. So there's no extra lines to be drawn in. But that's all I'm really ever looking for. I'm looking for, are there any sort of key levels to pay attention to within the slope? Let's see what's going on here in equities, by the way. Okay, we're just not a lot. So let's go and look at treasuries. Here we go. So actually, treasuries is a good example. So we drew in a downtrending slope, and I would look. And the way I draw lines on charts, by the way, just to be clear, if you see a solid line, I consider it to be a proven line. It's worked. It's been respected. I mean, hopefully you can see that both of those blue lines have been respected. Once, twice, 3, really 4, 5 times. Once, twice, 3, 4 times. So both of those lines have worked really very, very well. Whereas this line here, I'm probably just a little bit more on the fence, because you can see that we do actually have a high in this area here. We come close to it there. You might argue that there's a bit of support there, maybe a bit of resistance there. So, depending, it's a subjective thing. It's subjective. You might say to yourself, actually, Paul, I think you're wrong. I think that is a proven line. I'm going to make that into a proven line. I'm going to leave it speculative for just now. Now we roll forward. And again, you can see that we're actually, think again about the runner and the treadmill. The runner starts running, starts working his way lower as he expends energy, runs out of breath. Where does he run out of breath? He runs out of breath at this level here. And just to be clear, and again, it differs from, I think, the way that a lot of people look at charts. This here is an equal low to this. If anyone disagrees with that, or if they're confused, say something. But hopefully you try and make that blue slope in your mind's eye a horizontal slope, and you'll see what I'm saying. They are both, basically that's a double bottom. To me, that's a double bottom. The runner ran out of breath at an identical level within the slope. When he got pushed backwards, the treadmill pushed him backwards to here, to here, to here. This is a triple top, if you want to call it. That's a triple top, and if you like, a quadruple top in this area here. But when we start seeing a change of behavior is right here. Once we start pushing above our ceiling, now where is our ceiling? Our ceiling is here. Once you get like 2 touches, it tells me, okay, we have a ceiling. That is now our ceiling on this slope. So once we push through the ceiling to the upside, that is a bullish event. And again, to reiterate what I said a few minutes ago, it does not mean that we're about to spike to the moon, but it is a bullish event. We could top at the next line, which, by the way, we do top at the next line. Now we take that line out to the upside. This is a bullish event. So even though we're falling 27th, 28th of the month, we are falling. Hopefully you're looking at this and saying, yes, we're falling, but it's a bullish event. We are looking for evidence of a turn, or a continued turn back to the upside in treasuries. If we fall, where am I looking for support? I'm looking for support in this area here. I'm looking for support in this area here. Those are the 2 places I'd look for support in treasuries. And you can see we get support, we bounce from it. We get support, we bounce from it. Bit of a flush. I don't mind a flush. Flushes don't particularly bother me. That's just a bit of a flush. Okay, looks like maybe we've got resistance in this area here. So resistance up above. Resistance in this area here and here. And then okay, we fall away from resistance back on the 5th of the month. Are we going to hold at support? We're pretty much at support right now. Nope, slide through support. Where is the next place I would look for support? Because it looks like this particular line here is giving way to the downside. Where is the next place to watch for support? It's going to be, whoops, it's going to be there. That would be the next place to look for support. I don't know if we reached it, did we? Yeah, we did. Okay, so we actually reached the next line of support all the way down in this area here. But as counterintuitive as it might sound, throughout this period here, at the back of my mind, I'm remembering this is a bullish looking chart. It doesn't look particularly bullish, does it? Because you're thinking, well, we just dropped from 143 down to 135. How bullish is that? It is bullish when you think again about the runner and the treadmill. The treadmill has pushed the runner all the way back up into this area here. And when he starts running, he can only make it this low here. Okay, we get a last gasp to the next line lower, but we are bullish because if you go back to the original slope, this is where we are spending all of our time. Now look where we're spending all of our time. So you can see we've stepped higher within the slope, or basically the runner is underperforming. The trend is weakening. Context is bullish. So I'm on alert for a turn higher in this particular vehicle. And by the way, this is no different from I think it was silver at one point. We had a very similar situation where we were looking for support. I'm pretty sure that we've fallen through that support now, but regardless. So now we go forward in treasuries. Do we see a move to the upside? Yes, we do. Now does resistance here, resistance here, resistance here become support in this area here? Well, I think we discussed that earlier on this morning. I think it broadly speaking did, but with the volatility that we saw courtesy of CPI, we definitely had a bit of a flush to the downside. There's no doubt. So to me, treasuries are actually looking fairly bullish using this very simple method of A, identifying a slope, B, once you've got a slope, identify the current ceiling and the current floor, C, identify when your ceiling or floor steps higher or steps lower, which is basically your changing trend strength, which is context. And when you do see, in this instance, an upside breach of a downtrending slope, or Conversely, a downside breach of an uptrending slope, it causes me to start looking for a slope in the opposite direction. So now that we've seen this pop to the upside in treasuries, I would be looking for, are we seeing a slope that looks something like that? Personally, I think if you're going to look for something like that, there's not enough granularity on those bars. I would be dropping down to a 20-minute chart, which, by the way, is exactly what we looked at this morning. And I said this morning, there you go. Maybe there's an uptrending slope for the 30-year on the 20-minute chart. So that's why I was looking for an uptrending slope, because we breached the downtrending slope on the 240. I think we did the same on the 10-year. There you go, 10 years, same story. Looking for an uptrending slope. We've topped at resistance. Again, think about the runner. The runner's run all the way from here to here. And now we're seeing a bit of a breather, a bit of a pullback. And what will be key to me is, where does the runner get pushed back to? Does the runner get pushed back to here, which would be very bullish? Does it get pushed back to here, which would be kind of neutral? To me, that would be neutral, because if you look, this is our floor. So therefore, if we got pushed back to here, that wouldn't be bearish. That would be it would be neutral. Sorry, no, I was going to say bullish there. It's not. It would be neutral. So, talked now about strength, runner on the treadmill, context. I'm reading off a list of bullet points that I've made for myself. Strengthening, weakening, changes of behavior. Gosh, I think that's, broadly speaking, a lot of what I wanted to talk about. Flushes, I haven't really talked about much, have I? Is there much I mean, I'm guessing most of you attend what I post into chat each morning. So you probably know the ins and outs of flushes in some ways far, far more, because I'm posting about them all the bloody time. But let's have a look and see what's going on in equities this morning. Have we seen flushes in equities this morning? I think the answer is yes. In fact, I think Irwin, once again, little star performer, has spotted one in E-mini S&P this morning. So you might be looking at that chart and saying, well, where the hell's a flush on that chart? I think the flush that he was looking is that particular high right there. So essentially, you've got your prior high in this area here. So, again, think about the psychology of a flush. And so we saw a very choppy start to the session, like horrible start to the session. Like Dow was like popping and dipping 200 points. It was untradeable. And then we start seeing a grind to the upside. And as we start seeing a move to the upside, you just know that what everyone's paying attention to as we rise, and bearing in mind this was a decent leg to the upside. We're up from, and this is ES, 3870s to 3960. This is nearly 100 points to the upside in E-mini S&P. And what people are looking for is, they're saying, okay, when can we take out prior highs? Can we take out this high? Can we take out this high? Can we take out this high? And so we start taking out highs to the left. And at around about like 11:30 this morning, there you go, 11:30 this morning, we actually printed the highest price we had seen since 3 o'clock yesterday afternoon. So essentially what we've done is we've taken out the overnight high right here. But look at the reaction. And I color these green typically. It's just the way I typically do it. So, in fact, let me just see if I've got this on. Oh, no, I don't have it. I have it for Dow. So I've automated the display. Let me bring it into view. So this is my Dow chart. So this is actually my Dow chart. I don't use Ensign for trading. I use NinjaTrader for trading. And so, for instance, this is my Dow chart with an indicator. This particular indicator, which you can see, it's coloring charts green and red. And what it's doing is it's actually highlighting to me where there are flushes on the chart. And I've got certain parameters that I can change. So, for example, how many bars to the left has it got to exceed before it considers it to be a flush? How many ticks below that prior high does it have to be before it considers it to be a reversal lower? So in this instance, you can see there was a flash back at 10 o'clock. I think this was yesterday. Yeah, it was a flash yesterday morning up in this area here. There were 2 flushes in the afternoon in this area here. Did they work? Depends on your rules. I mean, in this instance here, we bounced from like 31.8, it looks like, up to about 32.1, 300 points to the upside. This one was less successful, about 8 o'clock last night. Nice flush this morning. There you go. This is this is Dow. Sorry, this is a Dow flush that we saw this morning. So I don't highlight these. These are automated. As the bars print, this will automatically highlight flushes for me. So this is something that I've integrated into Trend Sniper just as a way to try and automate locating these flushes, because sometimes you don't spot them all. But regardless, Erwin spotted this particular flush this morning, and it's this flush that creates the momentum back to the downside. So if we look at it on a smaller time frame, 5-minute chart, let's have a look. So here we go. There's the overnight high. Sorry. Yep, overnight high. Overnight high in E-mini S&P. And so as we approach that overnight high, again, people are saying to themselves, oh my God, a reversal is underway, we're moving higher. And then we get that bar there, and you would say to yourself, okay, have we taken out the overnight high? And I have this very systematic way of looking at flushes, and it's the same every time. Has that bar breached the prior high? And my answer is no. It's basically, it has me watching. If the next bar, this is one close above resistance. If the next bar closes significantly above resistance, and the only reason I'm giving that caveat is if we now reverse and close at 39.54.5, and we close like literally where my mouse arrow is, that's not sufficient for me to call that 2 closes above resistance. That's an on the fence bar. We looked at that this morning, but I can't remember what vehicle that was. So the next bar will tell me if this is a breach or a flush. It's a flush. As soon as I see that bar there, I know we have a flush. I color it green. That's a flush. And now the way I would look to trade this particular vehicle, because of my trading rules, I've got like a 27-page document where I've laid out all of my trading rules, and I have like 5 different trading rules that I use. I would be short here, and my stop is up above the high of the day. So my stop is up. Let me see if I can scrunch the chart up a little bit. My high is up in this area here. My stop is up in this area here. My entry is in this area here. I don't think this has got filled because I don't think we reversed to 39.53, but let's have a look. Nope, we simply reverse lower. So you can see it is this bar here that is creating this momentum in the opposite direction. And so that's why I like flushes so much, because people get wrong-footed. The shorts, because let's be honest, half the world, as someone said in chat this morning, half the world is short right now. The problem is, when you're short and you see us pop up into this area here, above the overnight high, you're thinking, crap, I don't want to be short, I'm getting out of my position. And sure enough, that's exactly where we turn lower. And we have turned lower from 39.60 down to 38.85. Pretty solid leg to the downside. So I do like flushes. Conversely, by the way, let's assume it's not a flush. Let's assume that it's a breach. And by the way, it looks like we had another flush this morning. I did not notice that. Do you see the flush this morning? Right there. So the early morning low is right here. So let's have a look. So down we come. That's too close to the level. I wouldn't even read much into that bar whatsoever. I need another bar. Okay, so this could be a breach, but let's see what the next bar gives us. If the next bar closes beneath like 38.80, 38.81, something like that, I would be in breach territory. If it closes up above, really up above like 38.86, I would consider it to be a flush. That's a flush. Straight away it's a flush. And so if that's a flush, which it is, how would I trade it? You already know because I just showed you up above. I would be long in this area here, and my stop would be down in this area here. Oh, didn't get filled. Oh, got filled. Okay, so now it is filled. And actually, it would have worked out reasonably well. I say reasonably well. It worked out very well. That would have been long around 87. Your stop would have been down around. Actually, I'm being unfair here. You know, if you got a low at 73, I think with the best will in the world, you've got to put your stop below the round number. I would never put my stop above a round number. I'd probably put about 4 points below the low. So to be fair, that's a pretty chunky stop. 86 down to 69. But had it worked? Yes, it did. 86. You ran it all the way up. I would have been taking profit in this area here. I would have been taking profit beneath the orange horizontal line. And I'm kind of morphing now more into like trade management as opposed to analysis. But whenever I take exits and whenever I take entries, I never do them at the lines of support and resistance. They're always within the lines of support or resistance. And depending on the direction of the tide, again, think back to what we talked about with context and changes of behavior and trend strength and trend weakening. Depending on whether I think the tide is with me or the tide is against me, I'm going to be using one or two. Actually, I've got 3 trade templates that I use, and the trade templates are effectively low confidence, medium confidence, and high confidence, and they relate to basically the number of TPs that I use, take profits, as well as whether I use a trailing stop. So if I have a low confidence trade, it will automatically trade 1% of the account, and it will actually automatically have a single TP. If I have a medium confidence trade, 1.5% of the account, it will have 2 TPs. And if I have a high confidence trade, it will be 2 TPs with trailing stop, meaning that it will take 2 positions off. It will take half of TP1, 25% off at TP2, and it will trail the remainder continually, as long as lower highs and lower lows exist. And it will do that in an automated fashion. I don't need to do anything. The tool automatically will trail the position, and it will continually move the stop as new lower highs or higher lows are created. Again, I'm morphing completely away from analysis now and more into trade management. So, are there any questions? Because I've kind of been rabbiting on now for 45 minutes, and I'm conscious that there hasn't been a single question. So that probably means that no one can hear me, or everyone's very confused. I really don't know which of those it is. I see that we've got a lot more people in here now, so it looks like people have joined after 12 o'clock. So if there are no questions, I'm trying to think if there's anything else on my bullet points that I wanted to cover. I don't think there are. We talked about flushes, psychology. I mean, the only thing I can say about psychology is, unsurprisingly, based upon my accent, I grew up in England. And I remember learning to drive when I was, 16 or 17? 17. I think in the UK it's 17. I was 17 years old learning to drive. And the first thing my instructor said when I got into the car was, try to imagine that the only reason that every other car is on the road is to hit you. And if you do that, you can't go too far wrong. I think trading is kind of something similar, where if you imagine that each move in a vehicle is designed simply to get you on the wrong side of a trade, you can't go too far wrong. And again, that leads into flushes, where when you see a punch above a prior high and everyone becomes bullish, you actually sell. When you pop below a prior low, you buy. It's really very, very simple. The problem is it's counterintuitive. When you're reaching fresh highs, everyone wants to buy. It's the time to watch for a reversal lower. I'm not saying you just sell a fresh high, because that's crazy, because you could actually see a full-blown breakout. But very often, the place to become more cautious is when you're hitting a high. The place to become much more optimistic or looking for a turn higher is when you hit a fresh low. And to me, that's exactly what equities are doing this morning. If you think about it, where have we gone since when I did analysis in this area here? We've gone nowhere. Yeah, we dropped from 31.5.5 down to 4, went up to as high as 8, back to 4, back to 6. We're going nowhere. We're just catching people out on the wrong side of the trade. I think we're going to do that into the weekend. I think we're going to recover into the weekend. But having said that, to be absolutely fair, I was looking for the very, very same thing back on Tuesday and back on Wednesday. And let's be honest, neither of those worked out. We just couldn't take out resistance in this area here. But this little pop here, to me, is analogous to this little pop here. We keep seeing these little pops up into resistance, these little flushes of resistance, and then down we go. So I don't think there's anything bullish going on in this instance, Dow, until we see a breach of 31.810 to the upside. That's what I'd be looking for there. Anyway, I was kind of just buying 2 or 3 minutes talking about what was going on in equities to see if anyone did come up with any questions. No one has come up with any questions, so in that case I'm going to wrap things up. If anyone after the session finishes suddenly thinks of a question you wish you had asked, feel free to reach out to me either in chat or in email. If there are enough questions, maybe I'll do a follow-up webinar, but hopefully I've kind of given you a bit of a snapshot in terms of how I look at slopes, trends, trend strength, context, and flushes and breaches. So there you go. I will leave it there. Enjoy your afternoon. I will pop into chat for the next 5 minutes to see if there are any further questions. Enjoy your day. Take care. Bye-bye.